Hey guys, Joel Frank here, market analyst for YouTrading. And in today's educational video, I want to talk about the Fed. And more specifically, I want to talk about how shifts in their communication on the outlook for interest rates and other things like on the outlook for the economy. But in the example that I'm going to give today, there's been a shift in their communication on the outlook for interest rates. And I want to talk about how that can affect markets. So, I mean, let's jump straight into the example and we can explain why things have been playing out like they have been. So, this week we've had two Fed members, only one of whom is actually a voter, but still two members of the policymakers at the U.S. Federal Reserve come out and start talking about 50 basis point rate hikes. Now, just to give you a quick recap of where the Fed's at in its hiking cycle. Last year they were hiking interest rates aggressively, 75 basis points at a time. They did that 4 times in a row. Then they slowed to 50. Then they slowed to 25 basis points rate hikes. The interest rate currently at, what is it actually? It's like 4.5 to 4.25%. That's the target range for the current interest rate. And the thinking was that they were just going to keep gradually going with these 25 basis points until they get interest rates to sort of, somewhere just above 5%. So basically just a couple more rate hikes, like one or two more. But in wake of a string of super strong US data releases that we've had, jobs earlier this month, US services PMI, inflation was hotter than expected, PPI was hotter than expected, retail sales this week hotter than expected. In wake of this string of super strong data that basically just shows that the US economy is still really, really hot, we've now getting this shift in language. Okay, so Loretta Mester, president of the Bank of Cleveland, said there's a compelling case for another 50 basis point rate hike. St. Louis Fed President James Bullard said he will not rule out a 50 basis point rate hike at next month's meeting. And generally, the communications that we've been having from Fed members, other than this, has been that they still don't see the job as being done and bringing down inflation. A lot of them talking about how they want to get rates above 5% or into the mid 5% range. So it's been generally quite hawkish, and we're seeing markets responding. Okay, so this is the option market implied probability of what's going to happen with interest rates at the Fed's next meeting. Okay, so you can pretty much, using futures and option markets, you can pretty much bet on what you think is going to happen. And this is the implied probability from what those markets are saying. 79% chance of a 25 basis point rate hike, 21% chance of a 50 basis point rate hike. Now that's quite a big shift. If you just look 1 week ago, it was only a 9% chance of a 50 basis point rate hike next month. And if you go a month ago, it was only a 4.2% chance of a 50 basis point rate hike at the March meeting. So it's a hawkish shift that we've seen here. If you go out to say July, you can also see that there's also been a hawkish shift in Fed bets towards interest rates eventually going higher, such as, for example, what's the probability of interest rates in July reaching the 5.5 to 5.75% range? Well, that's now seen at about 21%. A month ago, it was seen as virtually impossible to happen. And a week ago, it was only a 7% chance. So we're seeing this hawkish shift in the market's pricing. We're betting on a potential 50 basis point rate hike and interest rates eventually moving higher, going above 5.5%. Now, how is this affecting markets? Well, you can see stocks here aren't liking it. They've broken. The S&P 500 was in this uptrend, but fears about this hawkish Fed has caused it to fall out of this uptrend below its 21-day moving average, below 4,100. And I'm thinking a near-term move below 4,000, a test of the 50-day moving average, 200-day moving average, and the 2022 downtrend probably likely. Why does an increase in Fed tightening expectations weigh on stocks? Well, let me just quickly show you what happens with the yields. If the Fed's going to be raising interest rates more, then that means that short-term US government borrowing costs are going to be higher, which is why we're seeing the 2-year yield continue to crawl higher. It's probably, in my view, going to go above the high from last November and potentially push towards or continue pushing towards 5%. If we're talking about the Fed taking interest rates to 5.5% and then holding it there for a decent amount of time later this year, then 4.6, 4.7% on the 2-year yield is probably not quite high enough. But anyway, this US government bond yield, pretty much the 2-year or the 10-year, is seen as a risk-free rate of interest. It's seen as risk-free. Obviously, the US government, they issue their own currency. They're never going to go bankrupt. They're always going to be able to pay back their own debt. That's why these yields, these bonds are seen as risk-free, and then these yields are seen as the risk-free rate. And when you're valuing stocks, there's that formula. I won't go into too much detail, but it's the discounted sum of future cash flow. Pretty much the profit that you expect that you're going to get forever from all of these stocks. But you have to use an interest rate to discount those future cash flows. And the interest rate that you use is the risk-free rate, which is those pretty much roughly those US government bond yields. So when they go up, you're using a higher discount rate, which means a lower stock valuation. So that's why we're seeing it weigh on stocks. And then there's another channel through which a more hawkish Fed weighs on stocks. A more hawkish Fed means that there's an increased likelihood of a recession, or at least of weaker growth, which hits earnings expectations, which also hits stock valuations. So that's why we're selling off in stocks. We've already talked about why bond yields are moving higher. Let's have a quick look at the Dixie, moving higher as well. I think I said earlier this week that it's going to hit resistance in this 105, sort of 60, 105, 70 area. Technically looking likely after the break out of this trend channel. Why does the dollar move higher when you get this hawkish Fed shift and you get those downside in stocks, upside in yields? Well, when yields go up in the US, it increases the sort of incentive to hold US debt as opposed to the debt of other nations, because that yield differential goes in favor of the US. Like, if you've got a 4% yield in Europe and then a 4% yield in the US, but then the yield in the US goes to 4.1%, some people are going to start shifting funds from Europe towards the US. That's rate differentials, basically how they work. And then obviously to do that, you need to sell your euros, buy your dollars, and then use your dollars to buy the US government debt. So it's like flows coming into the US as yields move higher. Also, the dollar seen as a safe haven asset. So when risk assets suffer, some people seek safety in the dollar. That's just the way it is. It's the global reserve currency. Like, it's just got that safe haven appeal. So sort of two angles there helping the dollar. And then we can just have a look at a few other asset classes as well whilst we're at it. You can see gold still moving lower. Gold very much negatively correlated to the dollar and yields. Why? Well, gold is a non-yielding safe haven asset, whereas yields are a safe haven asset but with a yield. So when that yield goes up, which is what we're seeing, the incentive to hold gold is reduced, because like the opportunity cost, like the amount of money that you're losing on that potential yield is rising. The opportunity cost is rising, so people are selling their gold. And also, this is gold that's dollar denominated. So when the value of the dollar rises, it's like a fraction, isn't it? The value of the fraction decreases. But to put it in a way that might be more understandable, when the value of the dollar rises, international demand for dollar-denominated gold is decreased because dollars are more expensive. So buying dollar-denominated gold becomes more expensive, if you get my drift. So that's why we're seeing gold coming off. That's pretty much the video, I think, guys. I hope that you have a slightly better understanding now about how a hawkish shift, at least in the Fed's communication, can impact markets. I hope I explained everything well there. That is the example that we've just seen. So I hope this video is also helping to keep you a little bit in the loop as to what's going on in markets right now. But yeah, guys, hope you enjoyed the video, and I will see you all in the next one.